Jackson Hole, coupon code at meetkevin.com, J-Hole, expiring Friday. Take advantage of it. Get the top 10 buy list, every trade alert, the alpha report, the private live streams, all 8 courses. Make sure to check out at meetkevin.com before Jackson Hole on Friday. Well, this Friday at 7 a.m. Pacific time, we hear from Jerome Powell as he heads to Jackson Hole to give the good old Jackson Hole Symposium opening speech, and markets are pretty tenuous for figuring out what the heck is he going to signal. Last time he spoke to us, he talked about the potential of us needing to be grateful that he wasn't hiking interest rates, while at the same time saying that the labor market is fine, which both of those make us wonder, is this guy just purely tone deaf? Does he not realize the pain that's happening in the manufacturing space, the pain that's happening in the retail space, the pain that's happening in parts of the economy affected by immigration or just the soft labor force? Anybody looking for a job right now knows what that pain is like. Well, Mark Zandi from, not Morgan Stanley, where's he from? Moody's chief economist. He says that's because 1/3 of our economy is only expanding, and the other 2/3 are either treading water or in outright decline. And this is interesting because when you put these pieces of the puzzle together, you do get a really confusing picture for what we're going to get with Jackson Hole this week. Last year at Jackson Hole, Jerome Powell basically set up for a 50 basis point cut after the Japanese carry trade disaster and the skyrocketing unemployment reads, the triggering of the Somme rule, and conveniently the election was around the corner, so we happened to get a 50 basis point cut, which of course they deny had anything to do with politics. Who knows, maybe they're right. But point being, last year we had a Jackson Hole that's set up for rate cuts. This year, we've got a Jerome Powell who's potentially saying, hey, y'all need to be grateful that we're not raising rates, and we don't want inflation psychology to take over at the same time as 2/3 of our actual functional economy is either teetering or declining. Now, I think Mark Zandi's sheet here is actually quite interesting because it also aligns with what Warren Buffett just did. So let's touch on that, and then we'll get back to Powell. So we'll go on a tangent here. Look at this for a moment. Real estate at the largest share of value added out of all of this, even past healthcare services and technology. Now, I personally found this really interesting because, as you know, this isn't to be a pitch. I started a real estate startup in 22, knowing that, I like starting businesses when it's really hard to do it because there's no competition. So rates are skyrocketing in 2022, probably the worst time to start a real estate company. I start a real estate company, which is almost intentional because you then set up a really strong company for when the good comes ahead. Now, Mark is suggesting that the real estate sector is actually next to see a big set of expansion. And what I thought was so interesting was in Warren Buffett's recent 13F filings at Berkshire Hathaway. Take a look at what happened. First, look at the March 31st filing. On March 31st, so in the first quarter of the year, Warren Buffett added to his investments in the Pool Corporation, which the Pool Corporation is basically a wholesale distributor of pool pumps, equipment, cleaning supplies, tiles for pools, pavers around pools, everything pool related. They own 5 different distribution companies. And they actually take a 30% margin, which is really impressive. Now, they've got a PEG ratio of 2.9, so they're not exactly cheap or value, in my opinion. Earnings per share are expected to grow at about 10% for the next few years, but they're trading for nearly 30x on a price to earnings ratio. So I'm not exactly sure what Buffett is seeing here in terms of value. I think Buffett, when it comes to pool, is making more of a bet just on the real estate industry in a bit of a, for Buffett, diversified way. We know Buffett isn't a big fan of diversification, but the fact that we've got pool and then new buys, Lennar and D.R. Horton in Q1, and then you go into Q2, which was just reported. What did we find out in Q2? We find out big ads increasing his position by 265% in Lennar, increasing his position in pool by 136%, and then increasing his position, actually slightly shaving off of DR Horton, by about 1.79%. So sort of just rebalancing is really what that feels like at DR Horton. It kind of makes you wonder, like, what is Warren Buffett seeing? And I think what he's seeing is actually pretty straightforward. What you have is an environment where rates are going to come down one way or another, right? Powell talks about, hey, we need to be grateful that we're not raising rates, but we know we're in a trajectory of rates are going to come down. Rates are either going to come down slowly through a normalization, that is this setup that, hey, Mark Zandi was on CNBC this morning and he said, hey, the Fed's going to prefer making sure that we maintain growth because inflation could be sort of more of a one-time effect on inflation. So we want to make sure we don't push the economy into a recession. So they'll set up a 25 basis point cut is essentially what Mark is saying. Maybe. We'll see, because you've also got this other side of Powell, which we'll talk more about in just a moment. But either way, if you get a slow normalization of rates, maybe you prop up the real estate market pretty well. Not just mortgage companies like now the behemoth Rocket Mortgage, but also potentially the home builders who right now rely pretty heavily on incentives. This morning's housing market report indicated about 64% reliance on incentives versus 62% prior, suggesting basically home builders need to throw in more icing on the cake to get people to buy homes. Incentives, by the way, are things like rate buy downs, upgraded flooring for free, upgraded kitchen countertops, or crown molding, anything to kind of make you just say buy. Like, if that's what it takes for you to feel at home, honey, we'll make it happen for you. There's such huge margins on that stuff anyway, the home builders don't really care. Point is, Buffett jumping into pool and to home builders right now when it's unpopular to like the home builders, potentially because if we're going into a normalization of rates, mortgage companies through refinances or home builders could do really well as home suppliers. You buy a new home, you want to build a pool, great. More potential supply of pool owners or new pool owners to supply tiling or pool pumps or pool servicing equipment to. Makes a lot of sense. Then you also have the potential that if we do walk into a recessionary environment, rates plummet, which is probably also good for real estate. So at least from what we're seeing here, Buffett seems to be aligning with this idea of, all right, maybe we don't go all in on like AI and highly priced tech. Instead, where has the market been suffering? Oh, it's been suffering at the real estate side. Why? Because of rates. Well, what's about to happen at rates? Well, we're probably going to see rates come down either through a normalization or through a recession, both of which are, guess what, good and supportive for real estate, which is great for us at Alsac. It's one of the reasons, and this isn't a pitch, I'm just saying, it's one of the reasons why, when people invest in Alsac right now, we basically pay out a 5% yield plus 100% of the upside in the stock. So like you get all the upside in the stock and you get a 5% yield through the conversion. Read the details obviously at Alsac.com, because once the 5% converts, you hold the stock, and then of course the goal is we get to IPO. That's all a different topic. But the reason I say that is because we're kind of like, as a company, looking at it going, why do we continue to pay out 5%? We should at some point close that offering, and a lot's going to be predicated on what Powell does. If Powell's like, hey, we got to raise rates, all right, maybe we keep offering the 5%. But if Powell sets up for large rate cuts, maybe we kind of align with this Buffett strat of, all right, well, let's just, let's, instead of paying out all, this extra yield, let's stop paying out extra yield. Let's go buy more real estate and just hodl, because, the real estate market might be the next to boom, which is the bet that Buffett is making here. And it makes sense because interest rates and the success of real estate are pretty well correlated. That's why we think it's great that we are so heavily exposed to real estate during a really high interest rate environment where we have zero bank debt. Like, it doesn't really matter what mortgage rates are right now because we don't have any bank debt. But then when rates come down, we could refinance and we could join the, basically really explode the size of our company as rates come down, which is pretty awesome. But anyway, I thought this was so fascinating to see, Warren Buffett's alignment here with real estate. The question, though, is what if Powell actually signals rate hikes, right? If you look right here, take a look at what's happening to the odds of a 25 basis point cut. we had a 40% chance of a cut before the Fed meeting. Then we got to a 97% chance after the jobs report. And then after we got this blowout PPI report, we went to just an 84% chance. That's roughly where it sits now. I'm looking at the market right now. We've got an 83.7% chance of a cut in September. We've got a 50% chance of another cut in October. And then by the end of the year, we're only pricing in 2.1 rate cuts. So unfortunately, that darn PPI spike really hurt. We were getting to where we were pricing in 3 rate cuts until we got this, as Bloomberg says here, the nasty inflation surprise. And see, this is where a lot of people get confused because they say, hey, Powell's obviously going to be too late because the labor market is suffering and inflation's going to be transitory. But the question is, what if inflation is not transitory, like it took 3 years to be transitory last time or more? That's the big problem, is Jerome Powell told us this in the last meeting. If we end up allowing inflation psychology to escape and people get comfortable with this idea that prices are going up and we're not doing anything about it, in fact, we're cutting as prices are shocking to the upside, then maybe we should actually go slower with rate cuts. Sure, maybe we get a 25 in September, but maybe we're only going to set up one and done. That's also possible. So it's basically a hawkish cut for September he could set up. And I don't know that markets will be very happy about that, because what you have is markets that believe the Federal Reserve cutting rates is going to unleash this boom of liquidity and stocks are just going to go even higher. Folks, by definition, that is greed. It is pure greed through and through. That's all it is. And that is classic in sort of a euphoric bubble. This idea that, oh, well, the Fed's going to cut and then things are going to moon even more. No. When the Fed cuts, especially routinely, it's because the underlying economy is falling apart. Markets don't moon on the Fed cutting. Markets moon on the unlimited bailout of the Fed. I mean, you could even look at the narrow subsect of COVID. Obviously you could look at 89, you could look at 2003, the Fed's money printing, you could look at February of 2009 with the Fed's money printing, and then of course COVID with the Fed's money printing. Every time the Fed goes and runs the printer, that's when stocks skyrocket. The Fed emergency cut rates at the beginning of March of 2022 during COVID. That's not when markets mooned. Markets kept falling. Markets didn't moon until the Fed promised an everything bailout March 23rd of 2020. That's when markets really mooned. So markets want the money printer, not rate cuts. But investors today think rate cuts are good for the stock market. No, rate cuts are good for real estate. They're usually a sign of bad underlying issues for corporate earnings and corporate growth, unless of course we get some kind of productivity boom. But this is where we have this struggle of this balance. And I think that's also where Mark Zandi, he put together an op-ed in the Washington Post, which we'll look at. This idea about relying on a productivity boom, we'll go through this in just a moment. This, the number is bad news for the economy. This has to do with the jobs report and the inflation reports, which we'll talk about. But people believe that we're going to get this productivity boom from artificial intelligence. But I was having this debate this morning with a course member in the in our Alpha report. Let's say, I believe that that was this morning. We were just talking about this morning, where there's a difference between productivity and efficiency, and this is important for us to talk about. Keep in mind, we have coupon code JHOLE that expires this Friday. Remember, when you go to meetkevin.com, you get all of the trade alerts that I send. All of the long-term buys, short-term buys, trades, but also, more importantly, every single day you get that alpha report, which is sort of my outline and setup for the day. If here's what I think for trades for the short, medium, long-term, here's the data to pay attention to, here are the lines to pay attention to. It's a nice, easy setup, and you pay once, you get lifetime access forever. So consider that, get in before the coupon expires on Jackson Hole Day, so that's this week. But understand, this debate we were having this morning was the debate between productivity and efficiency, okay? Productivity is getting things done. So, for example, if I need to get these 2 remote controls, okay, from this side of the desk to this side of the desk, what was the product of my labor? Well, I moved two remotes from one side of the desk to the other, okay? Now, let's imagine there's a conveyor belt, okay? And I don't know, that took me 2 calories, let's say, to move those remotes. But if I push the button on a conveyor belt, this conveyor belt moves these remotes with 1 calorie. So it's 50% more efficient, right? What was the productivity difference between the example I just gave you? Well, let's see what the result is. 2 remotes moved from here to here. The productivity is exactly the same. The product, that's the root word of productivity. The product is exactly the same. I end up with 2 remotes on this side of the desk when they were previously on this side of the desk. Now, I did so with half the calories because I used a conveyor belt of AI or whatever you want to call it. Cool. So, breaking news. Trump administration in talks to acquire 10% stake in Intel. 10% stake. I think that's higher than what people were anticipating, by the way, for Intel. So maybe not. I mean, the stock's kind of moving initially up, but now down. Interesting. We'll talk about that separately. But the point is about this productivity versus efficiency talk. You have to ask yourself, if artificial intelligence, if markets are betting on a productivity boom, but the reality is we're just getting work done faster, and then we have more time to sit around, to sleep, for leisure, or to do nothing, it doesn't necessarily mean we're gonna go out to Cheesecake Factory twice as many times, or we're gonna go on twice as many vacations, or that we're gonna employ many more people. Which, if we had more productivity, we might do all those things, because more people could also do those things. If we could just get our work done more efficiently, we just have more time for leisure and not necessarily economic productivity, at least in the near term. So these are going to be things that we have to evaluate as we look at this economy. But anyway, looking at Mark Zandi's piece here, okay, Mark Zandi tells us that if it weren't for the changes in immigration or the changes in the labor force participation rate, we would be heading towards 5% unemployment. This is true. We would be re-triggering the SOM rule if it were not for labor force participation, right? Kind of a big deal. So the labor market has flatlined so far this year. This is true. The unemployment rate is basically flatlining at about 4.2%. And part of that is because our labor force that once grew over 2.5 million workers a year or 2 years ago, 1 million workers a year ago, now is basically flat. And it's the foreign-born portion of our labor force is in decline, where it usually grew at 5% per year. We start wondering, all right, so our labor market's not really growing. So is this a good thing? And this is where I think I personally have a lot of frustration with Jerome Powell, because I look at Jerome Powell and I want to kind of shake him by the shoulders. I want to grab him by the shoulders and shake him and go, bro, J-Powell, you told us the labor market matters a lot. And now, and you've told us for years that the 3-month average of the unemployment growth is what matters, or the labor market's growth is what matters. 3-month growth has gone from around 200,000 to 150,000 of 3-month average labor force growth down to just 33,000 jobs. And now you still have the balls to tell us that the labor market is strong. And that's because he's redefining how he measures the labor market. Now he's like, well, the unemployment rate matters more than the 3-month average employment rate. Oh my gosh. J-Pow, changing the definitions on us. The reason he's doing this is simple. He wants to fight our inflation psychology. He wants to prevent us from accepting tariff price increases, which we broadly are. If we look at core consumer goods, super core goods, or we look at producer price inflation, both of these are rising at rates between 5.9 and 10% annualized inflation. That's really bad, and that's at the margin. The reason we look at the margin and annualize it is because that's where we're getting the change, right? Like we don't want to average out over the last year. What we want to do is really understand that the spikes we're seeing right here in producer prices at the margin right now are potentially just now getting started, and that we might have a lot more tariff inflation in the pipeline. That is a risk factor. Now, consumer prices. Bloomberg here shows consumer prices overall, but, and this is how Donald Trump gets, see, my average inflation rate annualizes out to 1.9% just by ignoring this big bar from January and just taking this. That's how Trump gets his math. But the problem is, this includes all goods. Energy, housing, food. If you just look at super core, this bar would actually be up here right under 0.6%. Now, why do we do that? Because super core, that's where we're looking at clothing, that's where we're looking at toys, that's where we're looking at things people are buying on a regular basis, appliances, cars, obviously not appliances, cars on a regular basis, but those are things that consumers in aggregate buy on a regular basis, not every individual household. And the point of that is those things are very visible. And those visible things are what Jay Powell is nervous about. He's worried that if we become accepting of those higher prices, we will sustain higher inflation for the next decade. We'll actually have higher rates, not lower rates in the long term. Now, I think that's unlikely because I think Jerome Powell is so concerned about being wrong on inflation again and ruining his I will fight inflation to the death legacy that he'll actually end up pushing us into a labor market recession. And I think that's exactly what Zandy is worried about. He says that you're actually going to see costs continue to increase because of a lack of workers. I don't really see that part happening. I think you're more likely to actually see workers fired, but whatever. Then you'll see, basically, we both agree, a declining labor market. And with the labor market stuck in place, unless productivity ramps up, which we don't think it will, the economy's growth will fall well short of the pace we've come to expect or price in markets, which is problematic because then we might end up looking like a Germany or Japan where we're constantly really low growth or on the edge of a recession. And he actually says, like, his bottom line is, it seems increasingly unlikely that the labor force that's so, sluggish and dead right now will come back to life soon. And instead, it's more likely that a recession is dead ahead. Now, remember, Mark's argument is the labor force is so weak that a recession is likely ahead. Jay Powell is, oh, well, we have so many inflation concerns, we need to make sure we don't have some kind of surge of inflation expectations. Forget about the labor market. Part of that is because Jay Powell believes that he can cut rates to zero and turn the money printer on and save the day, which is partly true. It's not just rate cuts, though. Remember that. To really bail the market out, you have to run the money printer. So this idea that, we're going to boom on rate cuts is misleading. Big rate cuts mean weak economy. So where does that put us now as investors? Well, it puts us nervous and on edge for Jackson Hole. Understandably so. Because Jay Powell can go in a few different directions. He could set up a 25 basis point cut, which the markets broadly expect. But it could be hawkish. If it's a hawkish setup and he sets up only maybe one rate cut this year, we might be in a place that Jay Powell walks us into a recession within the next 6 months because the labor market rolls over. We'll obviously get labor market data again in September. We'll also get our QCEW revisions the first week of September. We won't actually have the quarterly revisions, which will help us understand the beginning of the year a little bit better, until September this year. Previously, we got those in August. So unfortunately, it comes after Jackson Hole now. So that means it's increasingly likely that Jay Powell is going to continue to set up this pressure of, well, we'll just be data dependent. We'll wait and see. I don't know that's what markets are going to be looking for right now. We'll see. We'll keep you informed not only on the channel, make sure to subscribe, but also in the alpha reports. In addition, this hawkish 25 setup, which I think is probably the most likely direction, I think Jay Powell is also going to hint around this idea of, hey, if inflation expectations get away from us, we're going to have to hike rates. And he's going to do that solely to try to get people to get frustrated about inflation and to reject higher prices. If people stop buying stuff from wholesalers or from stores because prices go up, then companies can't increase prices and they take it in the margin. The downside of that is you're playing with fire because if companies take it in the margin, they end up having to lay off workers. So either way you slice it, you're definitely in a soft spot right now. And you got a hawkish Powell. Best case scenario, Powell sets up for rate cuts, and we get a rebound in jobs in September for the August report. Best case scenario. Hey, we're going to start with 25. We'll remain data dependent for the rest. Everything looks good. Then you get a big rebound in the labor report. That would be fantastic. You know, you get a 200, let me see what the labor report is looking for right now. You get a 200,000 jobs gain or whatever report for next month. That would be awesome. That's when you could really rally to all-time highs again. So let's go look at the labor report. So labor for September, which will be going into Labor Day. Let's get to, okay, JOLTS, stable, where ADP is expecting to be. The survey's not out yet for ADP. Non-farm payrolls, current estimate is at 88,000. Well, that would be okay. We could take that. That would be acceptable. A survey of 88,000 above the 73 of last time. So really, you have to beat that in the next report. That's what you're looking for. And that report will come out on September 5th, on Friday, September 5th. So obviously, we'll cover that very closely. Yeah, so that gives you kind of a setup as to where Warren Buffett's head is. Rates are coming down either way. Go long real estate. That's what my positioning's been with Alsac. Go long real estate. Rates come down. We're going to be huge beneficiaries without any bank debt. That's why, like, mega bullish on Alsac, no matter what. Like, rates slowly down or rates rapidly down, we're positioned great. You know, 14, 15 million bucks in the bank. You know, we're ready to crank. Plus what we can refinance without bank debt, which is awesome. Then you need this next jobs report on September 5th to come in bullish and Powell to set up rate cuts to really get to new all-time highs. If we get a weak labor report in the next, real estate still wins, but you probably will start to see more compression in the stock market as markets get worried about, we're going off a cliff here. Now, in fairness, between now and then, markets really love overreacting to unemployment claims. These weekly unemployment claims are really lagging data, and I highly caution those. But it is something that markets like paying attention to anyway, and so we'll see that this Thursday as well. So anyway, with that said, make sure you go to meetkevin.com. Get that alpha report every single day. We've got our top 10 buy list coming out. We're starting our top 10 buy list for long-term 10-year hold. So at least a 10-year hold on this top 10 buy list. And that starts this month. And you'll be getting those alerts not only in the alpha report, but as part of the course membership. So grab that so you can get the top 10 buy list for the next 10 years. You get all 8 courses. You get every private live stream in the alpha report. You get stocks and psychology of money, 0 to millionaire real estate investing, real estate sales and negotiating. Sales is the way to life. Even if you're not a real estate agent, you got to know how to sell. Property management, making money through social media and YouTube, getting stuff done with productivity, Trumponomics and the new lectures that are coming out. You get it all over at meetkevin.com. Go check it out before J-Hole and that expiring coupon code. But remember, Jackson Hole, coupon code at meetkevin.com, J-Hole, expiring Friday. Take advantage of it. Get the top 10 buy list, every trade alert, the alpha report, the private live streams, all 8 courses. Make sure to check out at meetkevin.com before Jackson Hole on Friday.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.